So this part we're going to be going through more about the systems, so the types of orders, looking at how to use the various trading systems that we use, and taking you through just like the general terminology of the markets also. So obviously we've done the basic introduction, we've looked at how charts are represented, how prices are represented, all the different tools we can use for technical analysis, and now we get to more of the sort of admin side almost of trading. So orders is this chapter. And first off, the types of orders that we have. Now, placing trades. When you place a trade, there's multiple different types of orders that you can utilize, depending on the type of trade and the type of strategy that you're going to be using. So when we use different orders, there's two types effectively. There is instant orders. So therefore, you're placing a trade right now at the current market price. So obviously buying or selling, longing or shorting, or you're placing a pending order. So an order that's going to be triggered automatically if certain conditions are met. So let's say that you want to sell, but you want to sell a little bit higher than the price is right now. Let's say you want to sell a resistance level. Therefore, you may place a pending sell order that will be automatically executed by the broker as and when the price, or if the price even hits that level. So therefore, if you're going to be using these different types, it's very important to understand, because if you aren't aware of pending orders, for example, and you only use instant market orders, it's not going to be very flexible for you. So therefore, you're going to be a lot more sort of constrained in what you can do. But if you understand how pending orders work, then you can, of course, broaden your sort of like strategy and make use of these various different types of orders. So we're going to look at the two different types in this part. First off, the basic market instant execution, and then understanding with some examples as well, the more complex pending order types that you can use and utilize for various different strategies. So first off, let's go through the instant execution or market order. Now, this order is going to be used when you want to buy or sell the market. Again, any instrument, it can be, Forex, stocks, whatever it's going to be, at the current time and current price. So therefore, let's say that you wake up in the morning, you do some analysis, and you see that the market is bouncing away from a support level. And let's say you've just closed a bullish engulfing candle. And you say, right, okay, I want to enter the market now. So I'm going to buy the market as it currently stands. I don't want to wait for any specific price. I'm happy just getting in. This is the sort of order you're going to use. So here we have an ABC. And let's say that the market comes down. You want to enter the market at this exact price where that sort of pink purple bar is. Therefore, if you're going to take a buy position, you want the market to increase in price. So, let's say it forms like a certain candlestick formation here. Maybe it's just formed a hammer and you want to buy now in expectation the price is going to go higher. So what about like exiting a trade? Because if you enter a trade, you also need to have predefined points where you're going to exit for either a loss or exit for a profit. So there's two types of orders we can use, called a stop loss or an SL, and a take profit or a TP, which we'll go through now. So first off, the stop loss. So this is a very important order for risk management. And risk management is another part we're going to go through in this chapter, where you're setting your maximum loss on the trade, and it can be predefined. So you know before you enter the trade, okay, this is where I'm going to enter, and if it reaches this certain price, I'm wrong on that trade. I'm going to get out for that loss that I've predefined and say, right, that's it, I'm done, look for the next trade. So an example of that would be the market's moving in a bullish momentum. And again, you take the same trade, so you want to buy the market and you buy it here. Now, of course, you expect that market to go up. You want it to go up. And if it goes down, you're wrong on the trade. So therefore, it's a possibility if it becomes very volatile, the market can just drop super quick. And, it's very difficult for you to actually get out manually without taking too much of a loss. So you may say, right, if it reaches this price, that's my stop loss. The market will automatically, or the broker will automatically take me out the trade if and when price hits that. Hopefully it doesn't, but if it does. So the market goes straight through, and of course it goes lower than your stop loss, but you will only take the loss that your stop loss defines. So the market will get you out roughly in that area. What about take profit? So of course you'd rather be using these a lot more than the stop losses, but you need to use both, but hopefully these will be hitting more. And this is going to be the opposite way around. So you're setting the price at which you want to take profits. So if you're buying the market and you want to take profits, you're selling back your position. And it's the same idea if you're buying the market and you take a hit on the stop loss. The stop loss is like a sell order, because if you bought something and you take a loss on that, you need to sell it back lower than what you bought it for a lower price. And if you take profit, You're doing the same but just higher price. Therefore, you're making money. You're selling back what you've just bought for a higher price. So these stop loss and take profit orders are also orders in their own right, as in sell and buy orders too. It's just the other side of the market to what you've done. So this will be the take profit. So let's say that the market's going down and you enter the market here and you want the market to move in the direction that you want it to go in. You're going to set take profit. So let's say you short the market. So you're going to sell that previous resistance, expecting the market to make a new lower low, and the market comes down and hits that level. Well, you're going to be taken out for a profit. And that take profit is going to be actually a buy order in the market, because this time you've sold. So if you want to make a profit on that, you need to buy back what you sold at a lower price, therefore pocketing the difference. That's the profit. And obviously, you'd also want to take a stop loss here too. You want to set a stop loss, because if it does go the wrong way, you want to be out. So you would set the stop loss higher than what you bought it. And let's say it's like 20 pips higher than where we first entered. So here's our entry price, could be 20 pips higher than that. If the market does go up and hit through that, then that's going to be also a buy order, because you've sold it and you're buying back for a higher price than what you've sold. So you have to pay up the difference. So always remember that these take profit and stop loss are also orders, buys and sells in their own right. So how about the pending orders? Now there's two types of pending orders, limits and stops. So first off, we'll go through the limits. And of course, they can both be used in various different scenarios. So the buy limit order is going to be used if you want to buy the market at a lower price than the current price. So that might be a bit confusing to begin with, but we'll make that clear. So the market is up at this point, so you've made an ABC. You want to buy the market, but not right now because it's too expensive. You want to wait for it to pull back, to correct a bit first, maybe back into a level. So you say, okay, I want to buy it if it approaches the previous high again. I think that might act as support. Therefore, I want to place a pending order. Well, you're going to have to use a buy limit, because the limit order is lower than the current price and you want to buy it. Therefore, you expect this and you hope for that. So remember that if you're setting a buy limit, you can also predefine, because when you're setting the buy limit, it has to be done before the market reaches there, right? Otherwise, you just instant execute. So you're doing this beforehand. Maybe it doesn't hit the level. Maybe it just continues flying. You just don't get in the trade. But you also need to set a predefined stop loss and take profit. So of course, if this is a buy limit and it just smashes down through that limit, well, because you're in automatically, you don't have a chance to get out. So you need to place that stop loss in case it just goes straight down. And if you're trying to buy it and you do on the limit, then that stop loss will be a sell order, because you sell your position back to the market for a cheaper price and take a loss. And if you set your take profit higher, of course, then that will be also a sell, but you're selling for higher and pocketing the difference. So we're hoping for that. What about sell limit? What's the other way around? So this time the market is a lower price than what you want to sell it at. So maybe it's a little bit too low. You think, okay, I want to sell the market, but I want it to pull back first into a level or into XYZ. You can utilize the sell limit order as a pending order to do that for you automatically. So ABC is the downside. It's really simple examples here. And let's say that you want to sell if the market pulls back all the way up to that previous resistance. So you expect the market to maybe go back there. If it does, you want to sell it and bring it back lower. Or if it hits there, the market will automatically enter you into the trade, and you're hoping for this. So now think again of the stop loss and take profit. If you set a stop loss on the trade higher than that price, because of course if you're selling, you want to make sure that you're out higher. If it does smash up straight through, that's going to be a buy order, because you're buying back what you sold for higher. And a take profit, let's say that the market does this and you automatically manually take profits. You don't have a take profit order, you just buy back your position while you're sort of taking profit manually. So that's just a buy position. So the second type, we've had our limits, now we have our stops. So the buy stop order is going to be an order where you want to buy the market higher than the current price if it reaches there. So of course with the pending orders, it's always an if, because it doesn't have to, you're just hoping it does. So a pending order higher than the current market if you want to buy. So the market does this sort of movement, and you say that you want to buy the market if it hits that area because you expect it to smash up through. So let's say the higher time, remember the fractal markets, let's say this is a 1 hour time frame, and on the higher time frames you expect this to be the reversal area to go higher. So you want to buy the market if it breaks up through that previous high. As it goes through, hopefully it does that and you go into profit. You're triggering the buy stop. So remember the difference, the previous one, it looked exactly the same, was a sell limit. because you're selling higher. Because this is buying higher, it has to be a stop. So therefore, that's the buy stop. Goes straight up through, hopefully. Now, sell stopper would be, of course, the opposite. So selling below the current price. So there's an order to sell the market lower. If it reaches there, therefore a pending order. So the market's doing its thing, and you want to sell if you break down through this level again. So therefore, if the market does this, and you're correct, the market, automatically be entered into that trade on the sell stop as the market makes its way down. So that's our various type of orders. And what we can do is, of course, utilize those orders in various different ways, depending on the strategy you're using. You may find that throughout your trading career, you only use one of those types of orders, or you use all of them, or you flip between different ones at different times. But technically, if you're placing your stop loss and your take profit, you're always using these different types of orders all the time anyway.